Greetings from New York City. It's great to have you here. Thanks for stopping by. There is a brand new Cathie Wood interview. This one is with Yahoo Finance, where Cathie Wood gets called on the poor performance of her flagship fund, ARKK. Because usually no one questions her on these shows. That's why I even feel compelled to make these reactions, because they're just like commercials for her.
Cathie, we have to get to your performance. Your ARKK down more than 60%. And I know we've talked about this before, that you are a longer-term investor. But if you look back 3 years, you've underperformed the S&P 500. If you look back 5 years, you've underperformed the S&P 500. In fact, if you go all the way back to 2014 when you started the ARKK fund, it still underperformed the market. So what catalysts can investors look for to turn that around? Is it going to be the interest rates?
Simple question.
Yes, we have never seen a market like this.
Cathie, we're just looking for the catalyst here, okay? Just give us the catalyst.
Not only were the technologies not ready, the costs were way too...
Hey, Cathie, I'm living under a bridge with my family right now because we put a lot of our money in ARK. Can you please just tell us the catalyst? Because I'm about to have to start playing the skin flute just to pay for a meal. Thanks so much, Cathie. Appreciate that. Love you.
See what I mean about latent profit?
No, we don't get it, because you're acting like you're on Dancing with the Stars and dancing around all these questions. Just answer the question, Cathie.
They have a lot more to spend.
Come on, Cathie.
To make bone of the healthcare.
Cathie does not like to get interrupted. I just want to let you guys know she's very nice, but she's on here to do her commercial for her funds, not to be asked real questions by a journalist, okay? This is a commercial for her.
Still loses money. Right?
She's like, you're ruining my commercial.
This is what I'm getting back to. High gross margins, high 60s, low 70s. This company, its ultimate profitability is going to be superior because we believe it will become. We believe in love and love. The healthcare information backbone of the United States, if not elsewhere. Just think about that.
She wants you to think about anything except the performance of her funds. just think about that.
And yet the stock is selling for, I believe it's around...
We believe.
And the reason this has happened is because...
The Lord giveth, the Lord taketh away.
Thanks be to God. Investors are scared to veer much away from their benchmarks. They are selling any stock that's not in their benchmarks.
Well, I mean, in some cases...
Oh, interruption number 2. Ooh, Cathie doesn't like this.
They're scared with good reason, right? I mean, because they've lost a lot of money.
Julie, just one sec.
Sure.
So if I...
Wait, by the way, Cathie totally knows that she was a little bit heavy-handed there. She kind of went off brand there for a second.
They're scared with good reason, right? I mean, because they've lost a lot of money.
Julie, just one sec.
Sure.
So
that reminds me a lot when there was an interview with Tom Cruise where he's like, Bill, put your manners back in. I'll have to find that.
Peter, put your manners back in.
If I can just finish this thought so that you understand and so that your viewers understand.
Ooh.
So they have been selling our stocks because they're not in the benchmarks, and it has reached an incredible level. But I also think if you ask where the risk is now in the market, I think it's in the benchmarks that everyone...
She's been saying this forever.
...is crowded into because they're very backwards looking.
You have investors investing in the past. Benchmarks are where they are.
Investors in the public markets have defaulted to benchmarks, which are all about the past.
The pendulum towards benchmark style investing will swing the other direction.
If you invest in, let's say, the S&P 500 index, you're guaranteed to do no better or no worse than average, minus the expenses. The VU has a 0.03% expense ratio. You invest in that. If the market does 7% over a 20-year period and you just stay put, you're doing 6.97%. If you, Cathie Wood, who offers an actively managed ETF, there is no evidence that active management beats a passive indexing approach over a long period of time. Furthermore, she has a 0.75% expense ratio. It's not advantageous. There's a lot of reasons for people to do passive indexing. Her business depends on them thinking that's not a good idea or thinking that they should have some exposure to something like her fund, which is basically like a moonshot on a bunch of unprofitable companies and our research. I don't root against anyone making money. I just would never go near this stuff. I think people who have gone near it have learned, unfortunately, the hard way.
Most people will not construct portfolios the way we do.
They don't construct portfolios like we do, which is on a prayer.
We need the best companies who are going to execute on the future of these 5 new platforms. And we believe those are in our portfolio. So if no other reason, given the down round we've been through, if for no other reason, we would be a great diversifier for those.
See? Exactly. She's making the case of, add some ARK, get some diversification. Oh.
We know what we do, and our focus is completely on disruptive innovation.
And losing your money.
We are concentrating our portfolios on our highest conviction names. We've gone from 57, 58 names in the flagship portfolio to now 30 names.
If you actually knew anything, you wouldn't have 30 names. You'd have like less than 10 probably. I'd say less than 15.
Those which are the lowest on our scoring system have left. It's not like they won't come back into the portfolio.
Hey guys, I actually have a really big exclusive here. This is Cathie Wood's scoring system. Yes. We believe. We believe.
I really believe.